wonderful to see you all today. My name is Rebecca Self. I'm a founding advisor of the Global Advisory Alliance. Now, after I'll call that GAA. It's great to have you all here today at this co-hosted webinar with GAA and the Corporate Secretary International Association. Very pleased to welcome the President of the CSIA for some opening words. By way of brief introduction, Fumi Akundeo is an alumni of Harvard Business School and the University of Lagos. She is a fellow of the Institute of Chartered Secretaries and Administrators of Nigeria and is the Group Managing Director of STL Capital Group Limited. Fumi, over to you for some opening words. Thank you.
Thank you very much, Rebecca. I hope my audio is good. Wonderful morning, afternoon, everyone, from wherever you're joining us from. On behalf of the Corporate Secretaries International Limited, CSIA, I am very delighted to have you join us today. The demand for strong, ethical, and effective governance continues to grow worldwide, and CSIA is well positioned to make a meaningful impact. With more than 15 years under its belt, CSIA has made great strides in building a platform to provide a unified voice for corporate secretaries and governance professionals. Structured as an international federation of about 13 national professional bodies, CSIA represents more than 100,000 corporate secretaries and governance professionals throughout 3 continents across the world. CSIA's strength has always come from its members, combining the knowledge, leadership, and commitment to advancing governance practices across sectors, regions, and disciplines to build a vibrant, inclusive, and forward-looking professional community. By working together, we strengthen our professional community, expand CSIA's reach, and contribute more actively to global governance conversations. Our growth as an organization is driven by collaboration, and we're excited to be co-hosting today's webinar with the Global Advisory Alliance, GAA. We begin the year with a timely and important discussion as sustainability continues to reshape how organizations operate, report, and create long-term value. Corporate sustainability reporting is essential for sustainable value creation because it enables companies to make more informed strategic decisions, improve operational resilience, and align business models with stakeholder needs. Transparent sustainability reporting also strengthens trust with investors, regulators, customers, and other stakeholders, and also supports access to capital and enhances corporate accountability. The OECD Global Corporate Sustainability Report 2025 provides critical insights into emerging expectations, regulatory environments, and alignment, and also evolving role of sustainability across jurisdictions. Today's webinar will examine what these developments mean for us practitioners in practice, for organizations, for policymakers, and the broader global community. I therefore encourage you to engage actively with our speakers and take advantage of the perspectives shared. I want to thank you once again for joining us today, and I look forward to a productive and insightful session. Thank you very much, and welcome.
And Caio, over to you.
Thank you very much, Rebecca. Good morning, and good afternoon, and perhaps good evening to some of you. And thank you very much for the invitation by GAA and CSIA for my presentation today. So I will give you an overview of the 2025 Global Corporate Sustainability Reports. In my presentation, after a brief introduction about the reports, I will share some of the trends, some of the market practices that we have identified in our reports, and then share some key policy insights from our analysis. So as an introduction, I would just like perhaps to point to some of you that actually all the analysis that we have in these reports actually is connected to a key set of recommendations from the OECD and from G20 countries, which are in the principles of corporate governance, and also some of them in the OECD guidelines for multilateral enterprises on responsible business conduct. So if you want to know a little bit more about the recommendations from the OECD to policymakers and companies, you can access those documents. But in this report is basically more about identified market practices. So to do that, we have collected information from more than 80 markets, including more than 40,000 companies representing 125 trillion of market capitalization. And we have collected information that was, most of them, disclosed last year in 2025 about end 2024 information from companies. In terms of market practices, here in this first slide, you can see the share of companies that have disclosed sustainability information. So in the dark blue columns, you have the absolute number of companies, and in the light blue columns, you have their market capitalization share. And inside the columns, you have some numbers, and these numbers are the percentage points increase from 2022 to 2024. So for example, globally in 2024, we had companies representing 91% of global market capitalization disclose environmental social information. And this represents an increase of 5 percentage points in relation to 2 years before. So it is quite an impressive increase, but also the current picture will show that at least large companies, almost all of them, are disclosing sustainability information. We can also see, I mean, not in this slide here, but in our reports, there is also some variance in relation to the disclosure levels, depending on the economic sector. So, for example, companies in the energy sector, they tend to disclose more information. So companies represent 94% of market capitalization in the energy sector. They disclose sustainability information. And we have a smaller share of companies, for example, in the real estate sector disclosing sustainability information. And also in our reports, we identify the standards of disclosure used by companies. So we see, for example, that as of 2024, we had more companies using the GAA standards, a good number of them as well using the SASB standards. But the trends, what we see in the margin of new disclosures, we see that there is an increasing adoption, as you would expect, of the IFRS S1, S2, and also the European Sustainability Reporting Standards. But as of today, there is still a relatively small number of companies, less than 1,000 companies, for example, disclosing in line with IFRS S1, S2. And, but I mean, I think that there are two aspects that can increase the quality of the sustainability information. One of them is the use of high quality standards, such as the IFRS S1, S2, but the other one is the provision of third-party assurance about the quality of the information. So here in this slide, we have the levels of the provision of assurance for companies that have disclosed sustainability information. So, for example, we see that among the companies that have disclosed sustainability information, companies representing 81% of market capitalization, they also provide assurance at least for a few metrics in their sustainability reports. And among those that provide assurance, we see that the majority provides a limited assurance, which, I mean, as the name suggests, provides a relatively limited level of checks about the quality of the information, and only a minority of them, 17%, provide reasonable assurance. And reasonable assurance is the same level provided for financial reports. I think, sorry, I jumped in. So here now we have information about the equity shares of different types of shareholders, of investors. for two groups of companies. So in the first group of company here to your left, we have the 100 highest emitting companies, listed companies in the world. And to your right, you will have the 100 companies with the highest number of registered green patents. So to your left, we have
And
high emitting
Caio,
companies. Yes.
sorry, could I just give you just to interrupt you very briefly for one moment? If it's possible to enlarge the screen and put it on the screen share mode, it's just a little bit hard to see what's on the screen.
Oh, really? Okay.
Thank you.
Is it better now?
Yes, much better. Thank you very much.
Okay. So I mean, here I think the point is to try to see who are the shareholders, and shareholders usually, I mean, they have a much higher leverage to change the strategy of the company. So here we identify, for example, that institutional investors such as asset managers, pension funds, they hold a very similar equity share in both the high emitting companies and the companies that really are developing the new technologies that are necessary for the climate transition. So we see them, they have then like a equal potential to change the strategy, but also at the same time we see that we are not really following a movement from high emit companies to green companies from the side of investors. So there is a possible issue there. And another issue that we have identified here is that the public sector, they hold a meaningful share of the high emitting companies, 18% of the equity, but they hold a very small share in the green, highly innovative companies. So I think there's another matter there to consider. And here I think that especially for our audience today, I think that this analysis here is especially relevant because at the top here in the graph at the top, we show the existence of board committees that have any responsibility for sustainability. So we see, for example, that companies representing 70% of global market capitalization, they have such a committee. And I mean, if perhaps what is more impressive here is that there was an increase of 10 percentage points from 2022 to 2024. And here in the graph at the bottom of the slides, we show that 2/3 of companies, they have variable remuneration that's linked to sustainability metrics or the existence of policy. So I mean, from our side, it's not that we would necessarily recommend for all companies to have variable remuneration linked to sustainability, but we show that I mean today many companies do have such a remuneration package, which at least show that they give importance to sustainability. And now moving actually to the second chapter of our report, where we focus only on energy companies. So we see that we have very high levels of disclosure of scope 1 and scope 2 emissions, which are the greenhouse gas emissions broadly under the control of companies. And with, for example, we have 90% of companies in the energy sector by market cap disclosing scope 1 and 2, but we have a quite lower level of disclosure of scope 3 emissions at less than 60%. And finally, of course, all the sustainability metrics are very important, but we also need to follow the money to see where the companies are really investing in the new technologies, investing in the transition. So here we are looking at the cash flows of listed energy companies in 10-year periods. And we see that in this period here, there was an increase in the net cash flow from operating activities. So the money that they were making for their operations, that was higher, that was about of 1/3 of increase. But we see that the dividends and share repurchases from those companies, they tripled. So the money that they were distributing to shareholders has tripled in the same periods, but the cash used to invest in their business was increased only 3% during this 10 years period. So it basically remained stable, showing that companies either they don't have any investable projects in, for example, to support the climate transition, or they might not have the incentives to invest in the long term. So finally, I'm going very briefly to some key policy insights. The first one, I didn't have time here to share the detail of our analysis, but we show that different standards are still broadly used by companies. So this just confirms the need of making those standards interoperable, which facilitates both the comparison of the information between companies and across markets, but also may reduce the cost of companies complying with different disclosure standards. The second point here in relation to third-party assurance, we show the high levels of limited assurance, and this might be reasonable for the current stage of development in many markets, but at least for some metrics that are especially material, financially speaking, there might be the opportunity for companies to provide more reasonable assurance. So for example, for scope 1 and scope 2 emissions. The third point here in relation to, for example, board committees and executive remuneration that I just shared with you, this shows that, sustainability, the need of good information about sustainability is not only civil society demand, but it's, really companies, most companies have really been convinced that climate change is financial material for them. In relation to the investor landscape, we show that SOEs, they can lead by example, considering that they operate in high emitting sectors, but they can also consider their role in investing in green innovation, which they have not been doing significantly. And we also see that institutional investors, they have a role to play not only in trying to engage companies in high emitting sectors, but they also have an important role to try to incentivize companies to invest in green technology, because they are important shareholders in the highly innovative companies. And we also see that in the energy sector, as just mentioned in my previous slides, they are not really investing significantly. They are increasingly distributing more money back to the shareholders. So there might be an issue there, either for governments to try to increase the pipeline of green projects, or for boards and shareholders to consider whether the companies may not be missing an opportunity to invest for the long term for the climate transition. And finally, I didn't have time to share our analysis about human capital, but I recommend you to read the report and check this analysis. And there we show that companies that face human capital as a material risk, they represent more than 2/3 of market capitalization. And while they have been already disclosing some important metrics, such as employee turnover, there may be more to be done. So with that, I will stop here. Again, I would recommend you to download the report and read it. And I'm here to answer to any questions. Thank you very much.
Great. Thank you, Caio, and really interesting to hear about the report and set that context. And next, we have two fantastic panelists. So we'll have a discussion about the report. Just briefly, I'd like them each to introduce themselves before we get into the discussion. And that's Dr. Agnes K.Y.Tai, who's the Director of the Great Glory Investment Corporation, and Utu Upanya, who's the Corporate Secretary from MTN Nigeria. Agnes, over to you for a brief introduction, please.
Thank you very much, Rebecca. Good day, everyone. Thank you for having me here. My name is Agnes Tai, again, in Hong Kong. I've been in the financial markets for 46 years, and since 2010, helping our family office invest in climate solutions. I train board directors globally and teach Hong Kong U. Also hold several governance roles at World Economic Forum, Global Future Council, the Chapter Zero Alliance, which governs 34 climate governance initiatives around the world, global reporting initiatives, and a couple of others, which all center upon mobilizing and equipping global directors in taking climate action. Very pleased to be with you here today. Thanks again.
Great, thank you. Pleased to have you too. And Utu, over to you.
Thank you, and good day, everyone, from wherever you're joining from. My name is Uto Upana, and I am the company secretary of MTN, as has been, Rebecca mentioned. I'm also currently the president of the Institute of Chartered Secretaries and Administrators of Nigeria. I am also from the CSIA. I am a council member of the CSIA and also the first awardee of the Global Corporate Secretary of the Year award. I have been involved in Nigeria in the code, especially governance code evolution. And so that gives me a front row seat into what we're discussing today. I continue to work alongside with other governance practitioners in Nigeria to continue to move the pace of our evolution. So thank you for having me.
Wonderful. Well, great to have you both today. And as a reminder to those who are on the webinar, please feel free to put your questions into the chat, and we will also share the report afterwards, and that will include the QR code. I can see that's been requested from a few people. And also, congratulations, Utu. And then getting into the discussion piece. So firstly, maybe for you, Agnes, Hong Kong is a global financial center, Nigeria, very fast-growing emerging markets. So how do you see mandatory reporting? Is this the right step for both of those markets? Should they be at different speeds? And generally, how do you see the current state of sustainability reporting action in your region or maybe the sector you're working in? And Agnes, over to you to start, please.
Right. Thanks, Rebecca. So Hong Kong has, we have our ESG disclosures regulations for all over 10 years already, started with voluntary, and then in 2015 started stepwise mandatory. Recently, we have aligned with ISSB. So the Hong Kong Stock Exchange, which monitors and oversees all the listed companies, will be implementing the standards that have been developed by the Hong Kong Institute of CPA. And these standards, the Hong Kong FRS, are definitely aligned with ISSB. So starting from January 1st, 2025, we already have mandatory Scope 1 and Scope 2 greenhouse gas emissions reporting from all the listed issuers. And starting from this year, we have even Scope 3 emissions. And then by 2028, we will have all the large listed issuers as well as financial institutions will have to mandatorily disclose. But I want to just come back to Hong Kong a little bit because very few people understand, Hong Kong is just a little dot on the map. What does Hong Kong do? Well, Hong Kong has a stock market capitalization of $6 trillion by the end of December. And our market cap to GDP ratio historically was between 11 to 17 plus times. Now, if you believe in Warren Buffett, he says that 2 times ratio is a bubble, but Hong Kong has been a very super bubble for many, many years. And we have cemented our position as the dominant hub for green, social sustainability and sustainability-linked bonds issuance in Asia. And last year, we captured 45% of the region's cross-border sustainable debt market. Not last year, but the year before, 2024. So to strengthen our position, we definitely want to have mandatory disclosures that align with global standards and that is absolutely necessary. And I won't be surprised to see that assurance is going to be required very soon, because I heard Caio saying that reasonable assurance has been happening in the more developed markets. But to your last question, what is the state? Well, in Asia, all our stock exchanges belong to the Sustainable Stock Exchange Network. And with that, all the stock exchanges have been adopting locally adapted versions of ISSB, and we are all progressively implementing the standards. And I believe that, like Singapore, Hong Kong, we start very early in 2025, stepwise. By 2028, all the Asian exchanges, I believe, would have their form of mandatory disclosures. Back to you.
Lovely. Yeah, thank you. And Utu, the same question to you. And thinking about Nigeria or maybe any other African country, it'd just be interesting to hear your perspective on the same question, please.
Yes, it was actually, thank you very much, Rebecca. And actually very interesting to hear Agnes's viewpoints. And then almost 12,000 kilometers away in Nigeria, we do see, we know that Hong Kong is a much more mature market. And Nigeria and a couple of other African countries have evolving markets. And so in Nigeria, stepping into Nigeria, we are adopting a phased approach and also mandatory moving from one to the other, because we believe that one, for public interest entities, that's where it starts, since they have a much more impactful footprint. I must pause to acknowledge the work done by the Financial Reporting Council of Nigeria, which has actually taken up the mantle to drive sustainability reporting in Nigeria, working, of course, with the Nigerian Exchange Limited for those companies that are listed on the exchange, and of course also the Securities and Exchange Commission in Nigeria. And so in Nigeria, one of the things that is being done is to deliberately phase it, because we believe that we need to build the capacity. We need to work on assurance. We need to develop the data systems as well. And so in Nigeria, the FRC has issued a roadmap. I must say that the roadmap report that was issued by the Sustainability Reporting Working Group that was set up by the Financial Reporting Council issued a document and has released this for input from the public. And they are phasing it into the early and, of course, the voluntary adopters. And I'm pleased to note that my organization, MTN Nigeria, is one of the 4 companies that raised its hand to say they will early adopt. And then, of course, it becomes mandatory for public interest entities in Nigeria from 2028. And of course, for much smaller companies in the SME bracket group from 2030. And of course, assurance phases have also been prescribed. So the public, this document was released for public exposure. And I believe, if I recall correctly, last week, all the inputs on the 20th of January was the deadline for submitting inputs. Currently listed issuers on the Nigerian Exchange Limited are following the NJX, that's the Nigerian Exchange Limited Disclosure Guidelines, which has been in place since 2018. And so ISB's adoption provides that common platform for investor grade baseline in the market. So Nigeria is really working consistently towards ensuring that fundamentally sustainability reporting is embedded in the market.
Yeah, thank you very much. So sort of similar direction, but there are some different speeds depending on that local context. And then getting a little bit more into that context and projects. So in the OECD report, It mentions there's sometimes a lack of bankable green projects. So I was again curious to hear from each of you, respectively, what specifically can make these projects difficult to finance? Is it policy, framework, context, currency? Is it lack of size? Is it investor perception? Perhaps something else? And what role can financiers play to really help address some of those issues and topics? And perhaps, Agnes, starting with you for your perspective.
Thanks, Rebecca. Before I answer your question, I also noted in Caio's PowerPoint that there was something very alarming on page 9, and that is with board structures, adoption of committees, and with incentives tied to their management and senior executives. In the US, the increase percent was so low. It was like 0 or 2%. And given that the US capital market, stock market is 60% of the world's capital market, that was very concerning to me. And then he throws another slide in saying that there was very few, maybe there's very few investable projects, which I totally disagree, because I'm not disagreeing with Caio, but I'm disagreeing with the companies that find themselves saying, the fossil fuel companies that find themselves saying that they don't find enough investable projects, because we also know that in the last few years, the total capex that is given to new oil and gas exploration versus given to renewable energy development has been around 4 times. So that means they are actually still channeling the money into their old businesses and rather into something that would decarbonize the real economy. So coming back to the sustainable or sustainability projects, the Hong Kong Monetary Authority in October 2024 have published what we called a Sustainable Finance Action Agenda. That is not only to decarbonize our sovereign portfolio in Hong Kong, actually get the banks to decarbonize their portfolios, as well as to help the region and the Belt and Road countries to get their real economy decarbonized by channeling money funding to those projects. And I believe Nigeria is one of our Belt and Road members since 2018. And we work closely together, I believe. And the Access Bank, through your UK branch, you established a branch in Hong Kong just 1 week after the Hong Kong Monetary Authority unveiled that Sustainable Finance Action Agenda. So I look forward to having this cross-fertilization and having capital flowing between Asia and Africa, because as you know, Hong Kong is really a super connector. We connect the world by having a very sound legal system, having our talents, having all the in place policies, not only about disclosures, but about how we're going to be investing. And we definitely observe the ICMA, the International Capital Markets Association's principles when we issue those bonds. As I mentioned, that last year, 2024, we captured 45% of all the new Asian issuances, thanks to China, because we have a lot of Chinese companies coming through using Hong Kong. And so my last point is really that for decades, and some over a century, that banks have been very active in Hong Kong. We have clear policy. We have globally aligned standards now. There are Hong Kong IFRS, S1, S2. We have a very liquid financial market. Last year, our market cap went to 6 trillion from 4.5 trillion because we had nearly 120 IPOs and very large ones. Sound legal system, plenty of talents. And so I believe that it is not short of bankable or investable projects in Africa or elsewhere, but mainly how the pipeline can be facilitated for a good flow. And Hong Kong has a big role to play. Back to you.
Yeah, thank you very much. And before posing the same question to Uto, just a reminder, if you do have any questions for the panelists after this, we'll open up and there's a small box called Q&A. So you can add your questions in there. We'll pick them up in a few more moments. Thank you. But Uto, over to you, to your perspective.
Thank you very much. And this is quite an interesting area for Nigeria, being literally the fastest growing economy in Africa. And when you even look at the population stats, we have over 220 million people living in Nigeria, and it is projected that by 2030, the youth, and we have a thriving youth population. Over 35% of the population are youth between the ages of 18 and 35. So those projections are such that are of interest to investors because you have long-term sustainability for any investment that comes into the country. But yes, there are concerns that are typically expressed about looking at these markets, not just Nigeria, but most African markets. One is currency risk and, of course, macro volatility within these areas. And I believe the various governments, we see governments putting in place measures to make sure that they are able to manage the macros and give an assurance of stability across markets. And this also dovetails into policy implementation uncertainty. Especially Nigeria, for instance, is going into an election year next in 2027. And of course, this has there's a general perception for investors. But one thing we can assure is that if we look back and look at the various transition years, there hasn't been much of an upheaval. And so that also gives a lot of confidence to investors that are ready to invest long term in countries like Nigeria. Again, this when looking at the governance, and this is where we laud the regulators because they have also been able to ensure that regulation and monitoring doesn't stifle investment, of course. But looking at how can investors looking inwards into Africa and Nigeria, they can look at price and hedging foreign exchange risk via local currency facilities, blended finance guarantees, etc., and paired with Nigerian offtake agreements. They can also look at anchor vehicles that give that, for instance, back green bonds, sukuk, and those sorts of vehicles, and also particularly pipeline building. We have the African Free Trade Agreement, which is also meant to look at the opportunities across intercontinental investments. And one of the areas that they can look at, and it was interesting to see the energy sector in the report that Caio shared. One thing that Africa requires is green energy investments. So that is a long-term area that is bankable and is green and is something that would benefit the majority of Africans. I mean, if I were to talk of, for instance, going to look for firewood, Agnes may be wondering, what is that? But that is a reality across a lot of African countries and an area where investors can look at in terms of sustainability type investments.
Rebecca, if I may chime in.
Please.
So the firewood's really, very interesting because if you use solar panels instead of firewood or charcoal or coal or diesel, you create carbon credits that you can sell in cold climate in Hong Kong and generate revenue for your projects.
Absolutely.
Just very, very quickly, China is Nigeria's largest trade partner. We have bilateral trade exceeding $22 billion in early 2025, and China has invested heaps of money into infrastructure, highways and power plants and so on. So we are friends.
Absolutely. Absolutely. And that is the beauty we're seeing even with the geopolitical shifts. We're seeing countries making new friends and new partners. And so that is an area that has great potential for investor appetites. Absolutely, Agnes.
Yeah, so I can hear there's that really crucial role of collaboration, the role of the financial sector, but also being mindful of the economic and sort of wider policy conditions in particular contexts as well. Really interesting. And again, a brief reminder to add any questions into the Q&A. And before we invite Caio back, again, tapping your wisdom, Agnes and Utu, maybe do you have one or two tips for board members who are perhaps looking to start or enhance their sustainability reporting, or maybe identify some of these new business opportunities or actions they can take? And maybe Utu, starting with you.
Thank you very much. I think this goes straight into the core of my day-to-day life because I'm sitting with the board, advising the board, seeing what they need to do is core to what I do day to day. And so one of the things, number one, is actually to build competence on the board and build that knowledge base. There is sometimes an assumption that because you sit on the board, you have extensive wellspring, endless wisdom with respect to that even impacts your fiduciary responsibilities. And so it has to begin with building that competence at the board, not just having a sustainability committee, but actually making sure that your board members are conscious. They understand what their role is as directors. They understand what they need to do in terms of sustainability reporting, monitoring, etc. They understand the trends in terms of the regulations and the evolving landscape. And then the board must make sure that there's adequate data, because data is so key. One of the things that you see is that companies may say a lot of what they do, and they actually don't tie it to how does this affect our long-term, our going concern? How does this affect our value chain? How does this affect our supply chain? I must pause here to say that companies should actually ensure that, and through the board, monitoring this, make sure that those within their supply chain are actually ready. There's that readiness appreciation, because it is important to make sure that you keep that supply chain open and active. In my organization, we spent about 2 years providing a tool for those in the supply chain to make sure that they could assess their sustainability readiness and even the reporting readiness. And the board committee on sustainability had oversight over this. And initially, some of these companies struggled to even understand what they needed to do. But we see that within that 2 years. So the board must make sure, because you must sustain your supply chain amongst others. And then, of course, make sure that the board must support regulatory engagement and advocacy. In markets like ours, this is very important. And that is why MT is its hand to be an early adopter, because that sends a strong message to the market and a strong message to other businesses within the system. It is one thing to say I am doing, and it's another thing to say to actually do it. And so this also means that there is a level of self-regulation that also must happen. And of course, the board, being at the helm of governance, must make sure that there's consistent, there's assurance within the system, and of course, make sure that it secures the going concern status of its business. And for us, it's important because as a company that believes that everyone deserves the benefits of a modern connected life. We provide services to over 85 million Nigerians, and looking at also the footprint of MTN across the African market and the Middle East, over 300 million subscribers. So that is a huge responsibility, and the boards across the markets that take on. Thank you.
Yeah, thank you very much. And Agnes, the same question to you, maybe just one or two tips, but also I can see a question in the chat, which is about board members and that shift from fossil to green. So maybe just addressing that question as well, if you could. Any tips for board members who are considering that? Thank you.
Thanks, Rebecca. I totally agree with every word that Uto said. Sustainability data really informs strategic decisions. But first up, a few years ago, the Hong Kong Stock Exchange has designated saying that company secretaries, corporate secretaries, they are the board's trusted advisors. So I really like the way she said that she's advising the board and getting them to be sustainability competent. So how does the board move from just traditional business to a greener board or green board? Data, very important, but how do you know what data you really need? So one thing is because your large customers, when they're doing procurement, they will ask you for the data, then that's one thing. And also you can look at the sustainability reports of your leading peers in your industry. But it's very interesting that if you voluntarily fill in a questionnaire by CDP, or if you are a supplier of one of the large customers who bank with HSBC, now HSBC and your large customer is asking their ESG agency, rating agency, to rate their suppliers. So if the suppliers will now have a very good ESG performance, they can actually potentially get a bank line from HSBC, which you didn't have possibly before, and also possibly enjoying a little bit of a lower interest rate in your loans. But most importantly, when you have that ESG rating, it's very easy for you to go to another large customer and get onto their procurement list. So it's all about growing your business the green way. So sustainability data, very, very important. But as Otto was saying, the boards really have to be forward-looking. If you're driving a car on the highway and you're looking at the rear mirror all the time without your eyes on the freeway, you're going to crash, right? So we really need to be forward-looking and planning for the future and doing the right things now, even though in the short term, there may be a little bit of economic headwinds as we see in Hong Kong and China.
Thank you. And I'd like to invite Caio back, please. And I can see one of the questions in the Q&A is actually about the report and about how that can be adapted for local context and perhaps where there are resource constraints. And I also just note the OECD report can be found on the website. It's a resource under and can be searched using Global Corporate Sustainability Report 2025. But perhaps, Caio, over to you on that question for around local context.
No, thank you very much, Rebecca, and also for Morai for the question. We have, as I mentioned just in the beginning of my presentation, we have the OECD G20 Principles of Corporate Governance, and there we have Chapter 6, and in Chapter 6 you have recommendations for policymakers, stock exchanges, or any self-regulatory institution that might consider to adopt a standard, a regulation, or a recommendation. And in those recommendations, for example, explicitly the OECD and the G20, they say that the requirement should consider the size of the companies, of the issuer, and also the maturity of the markets. And it says not only about the standards, but also about in relation to assurance. So, for example, even in Europe, to be honest, as it is today, to be very difficult and costly to require reasonable assurance for all the sustainability information of European listed companies. And of course, the situation in most of the other markets is even more challenging at the current stage. Because I mean, we all, I mean, institutions, accounting firms, etc. I mean, we are still learning on how to implement those standards, how to disclose information, etc. So we need to be patient and also consider both the markets, but also the specific size of the company that is disclosing information. So this is in relation to this question. But also there was another question, Rebecca, if I can quickly answer as well, from Nidara. And this is in relation to the benefits of, which is related to the other question, but which is about the benefits for companies in emerging markets to disclose the sustainability information. And also Agnes made a very good point just now in relation also to the needs from clients that, for example, based in Europe or in other more developed economies. That's I mean also HSBC as a bank also providing finance for companies. I mean, if you have your bank or your clients based in a more developed jurisdiction where sustainability regulation is more strict, so you also need to provide information. So it's not only about providing information to your shareholder, I mean, to your investors, but also to your clients. So there is also pressure there. But again, at least from the perspective of the OECD and for most policymakers and regulators, the requirements and expectations to disclose information is about financially material information. So in the end of the day, even if there is not a immediate impact in the cash flows in the next few years, if there is an expectation that the cash flows will be impacted in 10 years, 15 years, there is a case now for the company to disclose now, because at least sophisticated investors, they will need this information to know how better to allocate their investments.
Yeah, thank you for sharing. So really having that sort of both short-term but also longer-term perspective when thinking about this topic, really important. And I can see there's a few more questions in the chat that we haven't quite got to today, so we'll take some notes on those. But before we sort of draw to a close, I'd like to just ask each of the panelists, and perhaps to go in reverse alphabetical order, what's one closing word or maybe very brief closing sentence that they have for participants who are thinking about this topic today? And Utu, please, starting with you.
Intentional is the word I would use. Across, whether from the companies, from the investors, from the reporting aspect, one must be intentional, and intentional conveys so many things under that. It is being intentional that will get us mileage, the desired mileage that we want across the board from Nigeria to Hong Kong.
Thank you. Yeah, love that word. I could see a few claps and hearts in the chat popping up. And Caio, same point to you, please.
Yeah, I mean, what we see in the marketing, in the disclosures, is that companies are still disclosing, increasingly disclosing more and better information about sustainability. And usually what companies do is because they have demand from their investors, from their clients. So I think from the side of the market, sustainability is just, I mean, as important or even more important today than 1 or 2 years ago. So regardless of any regulatory or policy developments, I think that there's still a very strong case for us to work on improving the quality of sustainability information by companies.
Great. So getting started. And then last, certainly not least, Agnes, over to you. Final word or sentence.
Thank you. Disclosures is really the end, the last step of communicating with your stakeholders. And so your company really need to do something about sustainability before you can disclose anything. But I want to ask you to think about turning mandatory disclosures into your strategic advantage by adopting a forward-looking and value creation mindset, and make sure that accountability is in the core of your boardroom oversight. Thanks, Rebecca.
Yeah, thank you. So intentional, getting started, and having that oversight, but that opportunity mindset, really valid points. And just a final few words, GAA will host a closed table event for people who are interested in this topic on the 11th of February. If you're interested, please email team@globaladvisoryalliance.com. That's team@globaladvisoryalliance.com. We're also open to feedback if there are further questions, etc. as well. And then very finally, I have three thank yous. So firstly, thank you to the fantastic speakers today. It was so interesting to hear your insights, and particularly from respective regions and countries. We really appreciate it. Thank you to CSIA and GAA. And finally, thank you very much to all of you for joining today. We really appreciate the questions, the engagement. I've really enjoyed hearing the insights and very much appreciate you joining and hopefully keeping in mind some of those last words towards the end. Wishing you all a very good day. Thank you.